Hi guys, and in today's video we're talking about circle of competence to do with investing. So what is it? It's normally defined as your area of expertise. And normally people talk about that in terms of, the area of work you are, what kind of job or industry you work in, or the hobbies or serious kind of knowledge you have, or sometimes some investors like Peter Lynch, for example, the famous Fidelity fund manager, one of the best fund managers of all time, also talked about in terms of what you're buying as a consumer. So maybe, sometimes people knew Tesla really well. The early Tesla advocates knew about it and they had the opportunity to buy Tesla stock very cheaply. Or indeed, Apple or Google users, maybe they were using Google and thinking maybe I'll invest in it. Now, so you got those three different things: work, hobbies, and the things you buy. Now, what about other things? Well, sometimes people buy stocks on like a friend's recommending them, or even a YouTuber. Now, I would say that's kind of going further away from your core circle of competence, sorry. When you're kind of reaching out to other people or they're telling you about something, it's never as strong as something you know. Now, I want to turn this and flip this on its head, because I personally think the circle of competence is a limiting belief, and I'll tell you why. When I first learned investing, I started investing in 2008, 7, sorry, and I'd done some kind of fake investing, kind of practice investing before. And I guess my learning or my preparation was reading about Warren Buffett and Peter Lynch and a few investing books. And I only really knew retail stocks. I understood retail stocks, I was a consumer. And so I did okay. I bought Domino's Pizza, I think about 100p. And I think eventually it went to 1,000, £10, whatever. But the point is, for many years, from 2007 to about 2009, 10, that's all I did. Mostly it was like retail. So I was like in Domino's Pizza, I was in Topps Tiles, I was in Tesco's, because Warren Buffett bought Tesco. So I thought, well, that seems logical. Terry O'Leary was the CEO of Tesco. It was expanding internationally. Lo and behold, Warren Buffett sold it and said it was his worst investment in all time, or recently. So there's another example of why following other people into investments isn't always the best the best way, even if you're following someone like Warren Buffett. But thinking about that circle of competence, I was thinking after the great financial crash of 2008, through 2009 and 10, what was going on, what sectors were not working out. And I was actually thinking about Peter Lynch, to be honest, because I was thinking about cyclicals. I'd invested in growth stocks with Domino's Pizza, and that worked out pretty well. Although sadly, I didn't put in a lot of money because I grew up, single parent household and didn't have enough money really to put into it. But nevertheless, I knew about growth investing, and basically, I was like thinking about the economy in terms of what was going to do well and what was not going to do well. And in 2009, I noticed that there was a lot of news around cars, about the automakers in the US. And I don't know if anyone remembers at the time, but in 2008, 2009, there was like rhetoric around the markets and in the news that they were going to go bust. So that was GM, Chrysler, and Ford. And I think Ford went as low as like $1. So it went from I don't know, something like $10, $15 in 2004, down to about $1.50, something like that in 2009. And what happened is, my thesis was that it's a cyclical company. People weren't buying cars, and they were over leveraged, I believe, and that they were going to bounce back. That Barack Obama, the president at the time, with the automakers, was not going to allow the car industry to go bust. A bit like, I think I thought about it like the banks, like no one let the banks go bust in the UK, in the US, like the banks were saved. And I thought there'd be a bailout of the automakers. So what happened? I didn't do anything. And I looked again at Ford a few months later. In fact, I asked people in my family, about this. I would talk to them about investing. Of course, no one in my family cares about investing. So, and then I looked again, not much later in 2010 and 11, and Ford had gone up like over 10 times in that short period of time. Now, if you open a chart of Ford, it's a cyclical company, so it doesn't go one way, it goes up and down. But you'll see that, this is true, this is exactly what happened. And that was at this point, I was thinking, I've just invested in my circle of competence. I've just invested in retail. I've seen this cyclical opportunity and I've missed it. So I was pissed off basically. And I said to myself, I'm going to find another one. I'm sure there's others, in 2010 or whatever. So I scoured the market and I saw another cyclical industry and I found house builders. And house builders was completely outside of my circle of competence. I'd never invested in property at that time. I wasn't a homeowner. I wasn't in the trade. I didn't know anything to do with property. I had a sister, my twin sister's an architect, but she didn't help, in any way. So, who the hell was I, to be investing in or be thinking about investing in something completely different than what I was used to investing in. At this point, Domino's Pizza was starting to do really well. But I thought there was a cyclical opportunity. So I looked at the annual reports and I looked at the numbers, and I could see that the house builders were valued at less than their net assets. And when you see that opportunity, that's a bit like a traditional value stock. Ben Graham, margin of safety. If they had to liquidate these companies, then you'd be getting your money back basically, because their net assets were worth what they were valued at. Now I was a bit concerned because essentially, the price of houses can go down, so net assets, can fall, obviously, because it's kind of an auction driven market. So I found one stock, and it had gone from about 800 pence down to when I found it, it was about 50p, something like that, which was 2009, 2010. But I waited because I was nervous that it was going to go lower. And actually, in hindsight, I should have just made the investment because my thesis was right. Nevertheless, I invested about 100p. And by the way, when you're investing outside of your circle of competence, sometimes you can find companies that are quite scary to invest in. And if you've never invested in a cyclical, I can tell you what happens, because it's happened to me. The whole world was writing about how the house builders were going bust. Now, what do I mean by the whole world? Every newspaper in the whole country, every blogger, everyone was saying how these companies were going to go bust. Now, in the back of my mind, I was thinking about Ford, and I was thinking, there's no way the UK government is going to allow these big house builders, home builders, to go bust, because there was a deficit of housing of around 100,000 homes a year. So on the one hand, people think that the housing deficit, the number of homes that need to be built versus the number of homes that are being built is a new thing. But actually, deficit of housing started at about 2008. So it's been going now for nearly 20 years. Anyway, at this point, 2009, 2010, 2011, everybody was against these house builders. And this was outside of my circle of competence. But I'd done the analysis and I thought there was a very good chance the UK government was not going to allow these companies to go bust. So what did I do? I invested in more than one. The main one that I invested in was Barratt Developments. The reason I invested in Barratt Developments was because it had the lowest gross margin. Why did I do that? Cyclicals rebound the best when they have the lowest gross margins. Why? Because when they return to profitability, their profitability is higher than the companies, relatively higher than the companies that have higher gross margins. So if you look at the Persimmons and the Barclays and the bigger house builders, they didn't rebound as much as Barratt Developments and Taylor Wimpey, because they have so it was that kind of bounce between kind of low profit margins to high profit margins, because basically the other factor is they could buy land very cheaply, in the recession. So that was another obvious thing. They can buy land really cheaply. They can build when the economy recovers. And it kind of by 2010, 11, it was starting to feel like that it was starting to recover. So yeah, it went on to 6x. It took time, to be honest, but by 2016, it was a six-bagger. There was dividends as well, so it may have been like 6.5x or something. And I don't think many people in the whole country had done this. I think there might have been one fund manager who talked about it after the fact. I don't know if it was Terry Smith. Yeah, I mean, I'll put an article. I'll grab an article. Basically, people started talking about house builders in 2014. Years after I'd made that initial investment. I remember I was late. I could have bought Barratt Developments at 30p, 40p, 50p. I waited until it was 100p. Now imagine if I'd bought it at 30p, it would have been a 20 bagger in 7 years. That would have been pretty good. Anyway, word of warning about cyclicals, they go in cycles. And, if you have a chance to pull up that chart, both Ford and Barratt Developments, have been up and down since. I sold in 2016 and bought a house with a friend. Remember, I didn't start with a lot of money, folks. So this doesn't end with me giving up work and being a full-time investor, unfortunately. Had I started with 100,000 or 200,000, yeah, I'd be easily a millionaire by now. But unfortunately, I started with like 7 grand or something. So it didn't end that way. Anyway, circle of competence. Circle of competence. Right now for me, I feel I'm looking at my portfolio, which is incredibly focused, super focused. In most cases, or in my case at least, in my accounts, I've got my ISAs and I've got my SIP, and then I've got my other accounts. In my other accounts, I've decided a few years ago to have some trackers to balance out some of the ups and downs of share picking, which can be volatile. And I've noticed that the retail stocks in the UK, and AIM stocks have done pretty poorly in the last few years, since COVID. Even if like the businesses themselves haven't done too badly, the perception and the PE ratios and the valuations are pretty poor. Also, I think management I'm kind of thinking about certain companies, Cake Box, Tortilla, Boom, XP Factory, and I'm thinking they're great companies long term, but short to medium term, I'm thinking about other companies. I've started to look outside of retail. Mostly I've done retail. I should have done tech, to be honest. I used to work for Facebook, and I remember I think the share was at like, I don't know, 100 or whatever, and now it's at 400. And I was literally working there, and I was going to buy it. And when I was working at Facebook, actually, you had windows to buy it. You couldn't buy it any time because of insider trading rules and stuff. So I just forgot to buy it. Another mistake. Anyway, circle of competence. So I normally invest in retail. Probably should be investing in tech as well because I work in tech. Nevertheless, I believe the circle of competence is the core thing I've just mentioned earlier on in the video. It's what you do for work, the industry, etc., type of work you do, your hobbies and your interests, what you buy, and also what you can learn. Now, I'll give you one more example of the circle of competence and how it relates to me. About the same time, I don't know what year it was, 2010, 11, 12, whatever. I saw mining stocks, Xstrata, and I bought a little bit, and I tried to read annual reports, and at that point, I had no clue about mining, absolutely no clue. I think it was about the time that Warren Buffett sold Tesco. I was just thinking about Xstrata and just thinking, I just don't know anything about mining, nothing. So I sold it. I don't remember if I sold it for a loss, but either way, I was just glad to be out because I didn't really understand it. And I think when thinking about the kind of outer circle, which I would call the potential circle of competence, your potential circle of competence, that's the things you can learn. And then I think there's a wider circle, and that's the things one will never learn or will be too difficult to learn, too esoteric, too technical, too scientific, too whatever. And for me, like mining is in that field. Certainly then, I know a little bit more about the mining industry, only a little bit more, but still it's outside of my circle of competence. But I do believe there's one level outside of your circle, the potential circle of competence, and that's where you can learn about an industry. Now, I can't say what industries you can learn about because I don't know your specific context. But for example, I was in retail, but of course I could have invested in tech. I've been working in tech companies, finance as well. I've worked in banking. Obviously just doing growth marketing. That's my bag. Not in anyway. I've worked in those industries. So, and I've analysed the accounts of these other industries. I understood that housing and that automakers, car makers were cyclical industries. Surprising how many people didn't understand this. I went to the AGM of Barrett Developments, and this is when it had fallen to 100p. There must have been 100 people there. There was a lot of people. The most people I've ever, almost the most people that I've ever seen at an AGM. And I remember people were shouting. People were shouting at the board. And I was listening to the CEO and the CFO, and I could see what they're doing was good. And I spoke to the CFO at the time, David Thomas, and we got on quite well. And he gave me his cards. And actually, I've been in touch with him since. He answers my emails. He's the CEO of Barrett Developments now. Anyway, it was amazing how many people didn't understand that house builders, home builders, and automakers are cyclical companies. They do not go in a straight line. So people were shouting and really angry. At this point, I think my shares had doubled, so I was quite happy. I bought kind of towards the bottom. But the point is that it's really important to understand not only the industry and the company, and be that in your circle of competence, but also understanding the style of stock. Is it a growth stock? Is it a cyclical stock? Is it a turnaround stock? And actually, the other thing about some of the shares I cover in terms of the ones I've invested in and talk about on the channel, Cake Box, Tortilla, and XP Boom, like I kind of think they're growth stocks, but they're not behaving like growth stocks. They're not growing store counts fast enough. They're not franchising fast enough. They're not building earnings fast enough. And maybe they are actually more like cyclicals because Tortilla has struggled. Some retail stocks have struggled to raise prices in the cost of living crisis. That means they're kind of acting more cyclically. Likewise with Cake Box, they blame the weather sometimes. And XP Boom, I think, XP Factory is a fantastic business, but they're expanding share count, which is a concern. So it's leading me to think outside of my circle of competence. And I don't think that's a bad thing if one can analyze one's ability and be quite self-aware of like the edges. So not pushing it too much, not pushing into I'm not looking at biotech, I'm not looking at med tech because I don't understand biotech. I know my limits. I'm not going to go into the extremes of mining, but I am looking at other companies, and I'm going to start talking about them on this channel because I think there's a similar opportunity to the one I saw with cars and house builders. I'm not identifying cyclicals, but I found some kind of turnaround type stocks, which I'm interested in and I'm going to be talking about. So I hope you've enjoyed this video. I think it's important for me to share some of my experience because it's valid. Just because I only started with, I think it was 10,000. That's what I started with. I didn't start with a huge amount, and that doesn't really matter. Had I started with the same amount as someone like Manish Pobrai, he started with 1 million, I'd probably have 10 million, maybe 15 million, 20 million by now. But anyway, I don't, just because I started with a small amount, I think my experience is very valid because it kind of doesn't matter how much you start with. Even if you start with £500, you learn lessons and you'll have those lessons for your entire life. So I hope you've enjoyed this video. Remember that knowledge is power, especially the right kind of knowledge, and progress is everything. Check out my other videos and I hope to see you soon. Like and subscribe, and take it easy.